What's up, everybody? Today we're going to talk about why credit matters when you're buying a car and why you should work to keep your credit score above a certain threshold. We're going to get into it right now. Welcome back to the channel. I appreciate the follow. I hope you're getting some information from this. And today we're going to talk about credit scores and why it matters and what you're paying for if you don't have good credit and how you can work on establishing that to build your credit up. So first we're going to talk about FICO scores. FICO scores are this company that dictates what your credit worthiness is when you're buying anything that requires credit to purchase it. It could be a house, it could be a boat, it could be a car, it could be furniture, all different types of things that you experience in your life that at some point you're going to have to take out credit in order to purchase these items. And they have a score that's attached to you based on your credit worthiness, based on your repayment history, how much credit you currently have, how long your file is, and what your repayment history looks like. So you have to keep track of these things over time using the monitoring service so that you can dictate what you can pay for things by having really good credit. For today's example, we're just going to take like a $30,000 car, and I'm going to show you the impact of what having stellar credit does versus how it goes down the scale and show you the difference between what you're paying for a car at $30,000 with a 720 plus score versus all the way down to like 600. And I can show you exactly like this is going to cost you thousands of dollars if you don't have the right score in order to purchase the car with the right credit score. I do want to point out that cash is always king. Like, so if you're paying cash for stuff, it's not a problem. But if you're like most of us, at some point in time, you're going to have to take out a loan because the cost of cars keeps rising every day with no end in sight. So even if you do have a bunch of cash to put down, or you like doing things in cash, it's getting harder and harder to do in the car market. Average prices of vehicles have risen up to over $35,000, and the average payment in America on new cars is $750. So if you're looking at a used car, it's about $595. So it keeps growing as time goes on, and that causes people to have to look at taking out loans or applying for financing on cars. And if you have good credit, or if you can work on your credit, it will save you thousands of dollars over time. Now let's go to my screen because I want to show you something that you can actually take note of and put these numbers on the screen for you to see so you can do the math yourself and help save you some money if you're going to be buying a car in the near future. Let's take a look at the screen. So you can see for this example, we have a $30,000 car. And we don't have taxes in here. I'm going to go ahead and put in Colorado Springs taxes. It's about 8.2%. And we're going to look at the best interest rate available right now for used cars for 5 years is 5.99. Now, if you look over here to the right, that is a $645 payment. Total of the payments, $38,727, which means you're going to pay $5,300 in interest if you make all 60 payments. You can avoid some of the $5,300 if you double up on payments or make an extra payment a year, or you find a way to make a $700 payment every month. That will help you offset some of this interest, but yet and still, you're going to pay some interest over the time and the life of this loan. Now, what the example I have right now at 5.99 is for clients who have a score of 720 or above. That gets you the best rate. How credit works is if you have the best interest rate, if you have the best credit score, you're going to pay a lot less in interest. They basically design the system that way. And let me repeat that for you. So it's not an equal playing field. Like, the score dictates how much you pay for money. So if you have a higher score, you pay less for the money. If you have a lower score, you pay more for the money because the risk of loaning you the money is much greater. So they want to try to collect as much interest as they can on that particular loan. Now let's go back to the example here. So if we change this to a tier 2 loan, Let's say you've got a 580, or I'm sorry, 650 score instead of a 720, the rate changes to 10.2. And if you take a look over here at this 5,300 in interest, it changes to 9,300. So 9,300 minus 5,300, it's simple math. That's another $4,000 in interest, right? So that's why the payment goes to 712 instead of the payment that I said earlier in this video at 5.99. This is how this is done. You are going to pay more for cars, and this causes other things. So if you see this, right, you might think, well, I'm going to get a cheaper car. I'm going to go get a 25,000 mile car, which could end up costing you even thousands and thousands more. And I know what I'm saying doesn't make sense right now, but stay with me. Here's what I mean. If you can afford the $30,000 car, if you can't afford it at 712 a month because your credit score is not high enough, and then you choose to get a vehicle that has more miles, is older, and does not have a warranty, but the payment is $100 less a month, you may think you're saving money. And on paper, you're going to be correct. However, this car will have no warranty when you start the loan, meaning, what if something breaks? What if something goes wrong in 6 months? You're going to end up having situations where random additions to your payment are going to cause problems for you in the long run. So it's very important to work on your credit score to keep it high so that you will pay less for the money. That gives you buying power. Your buying power can buy security because you can get a vehicle that's still under warranty. You don't have to worry about things. You don't have to worry about a transmission or an engine or anything like that. These are the things that I'd like to share with you and hope it helps you when you're trying to figure out why you should have a better credit score. So here's what you can do to work on your credit score. If you are starting out, this happens in a couple different ways. Either you're young, like I was once young, starting out with credit, you make mistakes, and then it puts you into a bad tier, and then you've got to fight your way back to a better credit score. And if you are in that position, you have to buckle down and make your payments and get caught up on everything. Credit is like the prison system. It basically is designed to keep you in a loop. It's a bad negative loop. So if you don't get yourself out of it, you keep having to make decisions like buying the older car with lots of miles or a payment you can afford, and then they break, and then you have to make another bad decision about not making a payment on that car. If that makes sense, you're tracking, right? So how do you break that loop? Write these things down. You can get a cosigner to help you out, usually a family member. Leasing a vehicle with a cosigner could help you out. It's a little bit easier to get qualified on certain leases with a powerful cosigner, and those deals are only 3 years. So you could rebuild your credit very quickly if you have a nice cosigner. If that's not available to you, you can just work on allocating some of your funds that you're using for enjoyment to start paying back the money that you owe on bad accounts that are causing your score to go down. That's probably easy, like easier said than done. But it's nonetheless, if you want to build yourself up, you've got to make some sacrifices. Another thing that you should know is keeping your credit cards over 50% utilization drives your score down every month. So if you're trying to get your score up, use that credit card less and also pay it down below 50%. And that will start to raise your score a little bit, at least stabilize the down turn. So those are some of the things that you could work on. And I hope that this wasn't just too common sense, but like, I feel like, people don't understand this, and I wanted to share it with you. $4,000 and the difference, over a life of a loan is a lot of money. And if you're buying everything like that, houses, cars, furniture, whatever, that stuff's going to add up to thousands and thousands and thousands of dollars over the years. So I hope this video was helpful. And if you have any questions, you can always reach out to me, or if you want to add to it, drop it in the comments. I'd love to hear what you have to say about it. Have a great day.